In this video, we're going to discuss the differences between a call option and a put option. It's crucial, especially if you're just starting in options trading, to thoroughly understand these differences. They form the foundation of all trading activities. There are two primary types of options contracts, calls and puts. Everything in this domain revolves around these two contract types. Today we'll focus on long calls and long puts. In subsequent videos, we'll look into buying and selling these options and how risk diagrams can be adjusted by doing this. So let's begin with a call option. The long call option strategy, or going long or buying to enter, is a fundamental trading strategy. Here, you purchase a call option anticipating that the stock price will rise significantly beyond the strike price before it expires. For instance, consider buying a 40 strike call option. This is where the payoff diagram starts to ascend. So, right over here, this is where it starts to go up. So you've bought the 40 call, and the payoff diagram starts increasing as soon as the price starts going beyond 40. If the current price is, say, 30, you'd hope that it passes 40 in the future, which is your strike price, so that you can make a profit. But unlike buying a stock directly, a call option buyer leverages their position. Now, one contract, as I've said before, one contract controls 100 units typically. So it could be 100, it could be 50, it could be 1000. So it depends on the multiplier of that underlying stock. These contracts are straightforward to set up, requiring just a single option order. You basically buy a call with your desired strike price and the expiration period. You only need to decide what your strike price is and what your expiration is. For instance, an at the money option would mean if the stock is trading right now at 40 rupees, you'd buy the 40 rupee strike price or the 40 strike calls. And if the stock is trading at 30, you might buy an out of the money 40 strike call. So it depends entirely on where the strike price is. Now, we'll look at moneyness in detail in a subsequent video, so don't worry about that too much. Now, your choices depend on your bullishness and the time you believe you need for the strategy to play out. The maximum loss, of course, is limited to the premium that you've paid. So, if the stock is below the strike price at expiration, the option expires worthless, and the loss is the price paid for the call option. So let's say the price is at 30 when you buy it, and it goes up and down but does not cross 40, and then it ends somewhere here. Whatever happens, your loss is limited to this premium that you've paid, right? So if the stock price at expiration is below that 40 strike price, then your option expires worthless, and the loss is the price that you've paid for the call option. In our example, let's consider this at, let's say this is 2 rupees. 2 rupees into the multiplier of 100. So that's 200 rupees that you paid for the strike for this call. Now, if the stock price at expiration is beyond 40 rupees, so it goes way beyond this. Let's say it ends at 50 rupees. You can buy the stock at 40. That's your strike using the call option, and then immediately resell it in the market for 50, gaining a 10 rupees price difference per share. So 50 minus 40, that's 10 rupees that you make per share. However, if the stock only reaches 30 at expiration, there's no incentive to buy at 40 rupees. Since if the stock is available to you at 30, why would you consider buying at 40 rupees? You would rather go into the market and purchase it at the current market price of 30 rupees per share. So this scenario highlights the reduced risk in options with call options. Now, the profit potential is theoretically unlimited, but in reality, no stock price reaches infinity, right? So if it goes to infinity, then the profit that you can make is unlimited. However, as implied volatility rises, it has a positive impact on the strategy, on the call option, increasing the value of long options due to a higher probability of surpassing the strike price by expiration. So for example, if the price right now is 35, if the volatility is low, then the price swings here, swings there, but doesn't really move too much, right? Then the chance of it going beyond 40 is reduced, and therefore the value of the option also reduces. However, if the price is at 30 and the volatility is high, so it goes up to 50, comes down to 20, and then goes up again. Basically, if there are large swings in the price, there's high volatility, then the chance of it going beyond 40 is higher. This increases the value of the call option. Now, as time progresses, since time works against us, it negatively impacts the strategy. All options, as we mentioned before, have a limited lifespan, and as they approach expiration, their potential value diminishes, right? And at expiration, the strategy breaks even if the stock price equals the strike price plus the initial cost of the options contract. So this is where the break-even price is. So basically, the strike price plus the premium, which we considered to be 2 rupees. So in our example, with a 40 rupee strike price, if you bought 140 strike call for, let's say, in our example, 200 rupees, your maximum loss is 200. Your maximum profit is theoretically unlimited, and your break-even point is 42 rupees. This is the strike price plus the options premium. So you start profiting as the stock passes the 40 rupees strike price. That's the pivot point that we have here, but you'll only net a profit after recovering these 2 rupees as well, the cost of the trade. That happens when the stock exceeds 42 rupees. With this example, we've got an overview of a basic long call option. Now let's look at a put option. The long put option or the long put option strategy is another fundamental options trading strategy. Here you purchase a put option anticipating that the stock price will fall significantly below the strike price before the option's expiration date. Now, as compared to shorting shares directly, a put option buyer leverages their position. So a single put contract, as we mentioned before, controls, let's say, 100 shares, allowing you to establish a bearish stance on a stock with limited risk. Now, with a put option, you're essentially agreeing to sell shares in the future at a predetermined price. For instance, if your strike price is 40, you are committing to sell shares at this price in the future. Your objective then becomes to acquire those shares at a price lower than 40 rupees in order to profit from the difference. So, as the price goes down, your profit starts increasing, as you can see in this diagram. Now let's look at this with a different outlook. Let's consider this analogy. Imagine that you're a home builder and you have agreed to construct a house for someone at a cost of 1 lakh, okay? So that's your selling price for the house. Your goal, therefore, is to complete the construction, including material, labor, and all that goes into the construction for less than 1 lakh. If you manage to do that, then you will make the difference. Let's say you manage to build it for 80,000, right? Then the 20,000 rupees, the difference, is your profit because you've already sold that house for 1 lakh rupees. Similarly, with put options, you pre-sell stocks at a future price, hoping to buy them cheaper later on. So you've already sold it at 40 and you're hoping that the market will go down so that you can buy that at a lower price and sell it at that higher 40 rupee price. Now, setting up these contracts of the put option is straightforward. You simply purchase a put option with your desired strike price and expiration period. In our example, if the stock price is 40, you might buy an at-the-money 40 strike put. If the stock is trading at 50, then this would become an will become an in-the-money put. And of course, if it is at 30, then it becomes out of the money. Now, the maximum loss with long put options is limited. Similar to the call strategy, it's limited to the price that you pay. So, if at expiration the stock is trading above the strike price, let's assume this is 40 rupees, the option expires worthless, and the loss is the price you paid for the put. However, you're not obligated to sell shares at the strike price. So if the stock's value at expiration is 50, there's no reason for you to sell at 40. You simply let the option expire and absorb this 200 rupee cost. the profit potential for put options is capped at the stock's value dropping to zero. So although it looks infinite, it's actually capped because the stock price cannot go below zero. So the profit potential for put options is capped at the stock's value dropping to zero. As the stock price decreases, the profit in the trade increases. Now, the impact of volatility and time on put options is similar to that on call options. Increased volatility boosts the option's value, while the passage of time erodes it. So what do I mean by that? If the current market price is 40 and the volatility is low, the market is moving up and down but not too much, maybe just sticking around at this 40 rupee level, then the chance of it going beyond or lower than the strike price and going beyond to let's say 30 is quite low. However, if the volatility is high and the market is swinging up and down, then the probability of it going up and ending in profit is also high. This is why the value of the put option also increases as volatility increases. As time moves towards expiration, the value tends to go down and becomes zero if it is out of the money. So at expiration, the strategy will break even if the stock price equals the strike minus the amount that we've paid. So in our example, the 200 rupee cost of acquisition. So that would be 2 rupees over here. Our break-even point would be 38 rupees. To summarize, while we've covered a lot in this video, remember that calls and puts are foundational to options trading. Now, in our next session, we'll discuss the nuances of buying versus selling options.